Good afternoon, everybody. Thank you for that introduction. Good to see so many people here today. My name is Dan Brocklebank. I head up Orbis's UK business. I've been with the firm for 16 years, so I feel very fortunate to be leading up our efforts here as we make our investment portfolios available to investors in the UK for the first time, really. I also feel very lucky to have found a career that enables me to basically spend my working life doing something that I find particularly interesting. I bought my first shares back in 1993 when I snagged an IPO. The company in question was Devro PLC, which some of you may know. It's still listed on the London Stock Exchange, and they are involved in the glamorous business of sausage skin. I can hear sausage skin manufacturing. I hear some people whispering it. So I'm suspecting I'm the only person who can say their journey to the room this afternoon started in the world of sausage skin. So, but there we go. In thinking about what to talk about today, we went with a slightly cheeky title, and I hope you're going to forgive the playful nature of the title. It's meant to be a little bit of fun, but underneath it all is really a very serious message. I'm guessing it being Wednesday afternoon, and you're all here presumably voluntarily. You probably share my interest in investing to a certain degree. And we thought that it would be helpful perhaps to share some reflections on investing. In that no matter what you hear and what you learn about investing, some of the biggest obstacles to actually a successful outcome come from within us, come from our personality. And so I thought I'd start off by just saying just how difficult the challenge that we face in achieving a successful investment outcome is. And there's a great way to illustrate this is we're global equity managers. And if we're looking to put together a global equity portfolio, we basically have a universe of about 8,500 stocks that we could pick from. And you as individual investors can probably invest in a similar range through the choice available on AJ Bell's platform. And that's a big number, and it's a real challenge to focus time and effort on finding the best opportunities in there. But if you're then looking at the universe of investment funds and investment trusts, like we've heard about this afternoon, the challenge actually doesn't get simpler. It becomes even more daunting. According to a paper from Charles Ellis, if you looked at in the broadest definition, there are 76,000 investment funds available to global investors that you could be looking at. And the really sobering fact is that only 20 of those actually earn their fees over the long term as well. So the challenge really is difficult. And the real question today is how to filter down from that universe into fund managers. And so I think that's a difficult challenge. The other reason that investing is difficult is it's really a very unusual activity that humans sort of engage in. And I think this is much more important than is commonly realized. And to illustrate it, I'd like to ask you all a question. Can you stick your hand up if you've ever been to Las Vegas? Okay, that's a way over the majority of the room. Okay, now can you stick your hand up if, when you were in Las Vegas, did you manage to prise yourself away from the tables or the entertainment long enough to visit the Hoover Dam? Actually, that's still quite a good portion, so well done. The Hoover Dam, for those who haven't seen it, is an amazing structure. It's 212 meters from top to bottom. And if I were to say to anyone in this room that I want you to build a road bridge just downstream from the Hoover Dam that crosses the river right by the Hoover Dam, I suspect most of you, unless there are any retired engineers out there, but I said most of you would say, well, no, thank you very much. If I said to you, okay, I'm going to put a gun to your head, you really have to build this bridge now. I suspect your thought process would change, and I would guess that most of you would say, well, okay, the first thing I've got to do is I've got to find some people who know something about engineering. I've got to find some experts. I've got to find some engineers. I've got to find some physicists and people who maybe understand geology because it's a funny landscape out there. And you might say, geez, Dan's got a gun to my head, so I better make sure this works. So you probably get a number of experts and check that they all agree. And that's what the people did behind this picture. This is a bridge being built over the river, just downstream from the Hoover Dam. It was completed about 10 years ago. And interestingly enough, I think most of life works like this. If you have a difficult challenge, you go out and find some experts. And if you were building this bridge and you asked 10 engineers how to build the bridge, and they all basically, 9 of them came back and said, well, you've got to build it just like they're building here in the picture. But one of them came back and said, well, let's build it, no, you should build it completely differently using different materials. I would bet that you'd all agree the most sensible outcome is to go with the majority of 9. The same applies if you get a doctor's opinion or if you get a plumber to look at a leak you've got in your house. And that's really how life works. The interesting thing is that in investing, it's precisely the opposite. If you ask 100 portfolio managers whether or not they like a stock, and 99 of them come back and say, oh, absolutely, yes, I think it's a screaming buy today. Chances are that the best thing you can possibly do is run it in the opposite direction and not own it, or maybe even short it. And I think that makes investing a really unique challenge because it's not geared up for the way we as humans are used to operating. Now, unfortunately, what that means is that the typical cycle that investors go through, particularly individual investors, looks something like this. A cycle comes along, something becomes very popular, everyone says you should buy it, our herding instinct kicks in, and everyone gets a bit greedy, so they start buying something. As and when everyone has finished buying, the cycle turns, panic starts to set in, everyone gets afraid because the prices are coming down, and prices drop, and everyone gets disillusioned, and they sell at the bottom. And the challenge that the real danger in investing is doing what everyone else is doing. Because the difference with engineering is that the rules in investing change depending on what the players on the pitch, actually doing from time to time. And so this is a cycle which, as you can certainly see, is not one that you necessarily want to get involved in. And what you actually want to be doing is precisely the opposite. Now, some of you I can see are nodding. You probably get this intuitively. Others may be saying, oh, well, no, that's not me, and I don't fall for all of that sort of stuff. The sad reality is that we can actually quantify how painful this is. And a firm in the US called Dalbar, based out of Boston in Massachusetts, measures this, and they've been measuring it for 30 years. And they've come up with something called the investor behavior penalty. And it's the term that they use to describe basically how much the behavior of investors is costing them relative to the opportunity set that they actually identify. And the investor behavior penalty, as defined, the way they measure it, is that they look at all of the funds out there that managers offer, and then they look at the experience of investors in those funds. And they measure the difference in the performance from the funds and the performance that the individuals get. So if individuals just invested at the outset and sold it at the measurement point, there'll be no difference. But if investors are buying high and selling low, as we suspect they are, you would expect there to be a performance gap. And the gap is sobering. It's 5%. And that's not 5% in total. That's 5% per annum. And that's not a fee issue. This is all on a like-for-like basis on a fee perspective. So this is a huge ongoing penalty that individuals are inflicting upon themselves. So the question really, to my mind, is what is it that you can do about that? How can you help yourself avoid that penalty? And at Orbis, we think investing can learn something surprisingly from the world of tennis. And there was a survey 20 years ago which looked at strategies in tennis. And it was really interesting because they started out by looking at the professional tennis players. And they analyzed the points won over a number of tournaments and matches. And what they found was that 80% of all the points won in a professional tennis match were won by one of the players playing basically a shot that was unreturnable. So it was a winning shot that the opponent was never going to get back. When they applied the same logic to the amateurs game, they found that precisely the opposite was the case. 80% of the points were lost by an unforced error. And what that means is that the best strategy you can employ as an amateur tennis player or even a table tennis player is just to try and get the ball back regardless and wait for your opponent to stuff up. I'm sure probably many of you who've played those games will know that intuitively that's probably right. Not nearly as fun as trying to go for that smash or that unreturnable shot. And it doesn't help by the fact that that strategy is typically referred to as the loser's game, which doesn't make it any more appealing. But we think that that's basically a good analogy for the successful strategy in investing. And it's really is to avoid the mistakes. And so what I've done today is just listed 5 behavioral traps that I think investors can avoid and hopefully, or can commonly make, and hopefully I can help you to avoid them. So the first one, spending time on GDP forecasts. Did you know that there is no link between stock market returns and GDP returns or economic growth? That's often a surprise to many people. If you don't believe me, here's a list of companies starting with South Africa on the left to Japan on the right-hand side. What I've done is I've looked at 110 years of data, and this shows the annualized GDP per capita growth over that period, 110. So lowest countries on the left, highest on the right. You would expect if GDP mattered when it came to stock market returns, that the best countries to be invested in were over here on the right, Japan, Finland, Norway, Italy, etc. That's what the stock markets did. There's no correlation, no relation. I find it amazing how much ink is spilt over forecasts, in the investing press, I should add, over GDP forecasts and economic predictions. Not only does it not matter, but I've also yet to find anyone with a verifiable and consistent record of long-term accuracy in their forecasts anyway. So one thing you can certainly do and save some time on is just stop reading all of that stuff. The second trap, and this is an interesting one because I didn't know I was going to be following John, and it's a shame it's not a panel, actually. We could have had some real fun. But don't be seduced by growth. Clearly, everyone wants companies that are growing fast. But no investment is safe if you pay too much for it in the first place. The best way, I think, to visualize this is to imagine yourself in a time capsule. We're going to go back to 1975. You're far-sighted in 1975, and you recognize that computers are going to be the next big thing. They are going to be a fantastic growth story over the next 40, 50 years because really we're just scratching at the surface and it's just coming. By contrast, the tobacco industry, it's about as good as it gets. Everyone's smoking. You can smoke wherever you like. Nobody has any idea that cigarettes are terrible for you. On this chart, I'm going to plot the share prices of the biggest two tobacco firms, the biggest two technology companies from 1975 onwards through to today. Now, I suspect if I just plucked anyone off the street and asked them to guess which was which, most people would say that the tobacco companies are the ones at the bottom and the technology stocks are the ones at the top. You, I know, are much more informed, so will not be surprised to hear that the bottom two are actually the technology companies, and tobacco is up at the top. And the key difference, clearly growth can be very valuable, but just focusing on growth in isolation is dangerous. You have to have profits growth, and profits growth is dependent on industry structure and not just how much the size of the industry is growing. Number three, ignoring valuations, kind of linked to the second point, really. And rather than go through another time capsule, I thought I'd look at what are the valuation metrics that people might be ignoring today or at risk of ignoring today. Let's start with the stock market. This is a history of the Shiller PE ratio since 1880. So again, we're long-term investors. Try to go back as long as we can. The ratio today stands at 33 times earnings. It doesn't really matter how that ratio is calculated. Suffice to say that when the line is high, share prices are high. And when the line's low, stock market prices have typically proven to be quite cheap. The sobering factor today is where we sit today, we've only been higher 3 times in the past. Let's just recap what happened first time. Well, that was the Great Depression. Shares went down by 85% shortly afterwards. In 2000, the tech bubble preceded a decline of 44%. Now, just to be crystal clear, I'm not predicting the market's about to crash. Absolutely far from it. This is not a timing metric. This is not a timing tool. The thing to be aware of is that we're not at one of those situations in time where the stock market is screamingly cheap. And that typically happens when nobody wants to get anywhere near the stock market. If we were running this conference in one of those times and nobody would be here, we might have 5 people here or something. But I think another key point is that if you're buying a tracker fund or an index fund, that is what you're buying today. You're buying that as the market average. Now you might think, well, okay, let's go into the bond market. Let's diversify. So I think everyone, again, will be familiar that bonds today offer lower potential returns. I'm sure for those of you who are retired, it's probably painful to remind you of the fact of how much yields have declined over long periods of time. But I think a really important factor that's crept up in recent years that isn't talked about enough is how the risk has increased with government bonds. And risk in bond land is measured in terms of duration. It's very simple. If a bond has a duration of 5, it means that if interest rates go up by 1%, the value of that bond, the price of that bond, can be expected to fall by 5%. Okay? So I'm going to add onto this chart a history of what duration of global government bond index has done over the last 30 years. I'm going to plot it on the right-hand side. And you can see that the duration of bonds has increased over the last 30-odd years to over 8. So what that means is that if interest rates rise or yields rise by just 2%, the value of the global government bond index can be expected to fall by 16%. Now, I don't know, I might be wrong, but I suspect that will come a very significant surprise to a large number of people. Point number 4, overtrading. A little bit risky, me pointing this one out at a seminar organized by a company who makes money out of people trading. But I have heard Russ Mull from AJ Bell make the same point, so I think I'm on safe ground. Overtrading is a key trap that people can fall into. And this is a sort of image from the classic image. And if you think about it, investment has all the hallmarks of a sort of competitive sport mixed with the addictiveness of sort of a social media or a computer game. Important to recognize that the objective in investing is about maximizing returns. It's not about minimizing boredom. Now, I suspect many of you say, well, I just like to play and have various stocks. And I think that's fine, but come on, we all enjoy doing it. But just be very honest with yourself about how much of your portfolio you have in your play section. Measure how well you're doing in that regard, and don't necessarily let that get too big a portion of it. Final point is linked all the way back, really, to the behavioral cycle. And the biggest risk, is, in my view, is chasing recent performance. And I think this is particularly relevant when it comes to trying to sort through that universe of investment funds out there. And the reason is that the industry and the press focus a lot on recent track record because it's easy to calculate and it's fairly objective. A better way we think to do this is to try and filter that universe based on some more qualitative criteria. And I'll just really put out there 3 questions you might want to ponder as you think through managers. Firstly is, what's a firm's ownership structure? I think if an investment management firm has external shareholders to please, then there's a risk that they have conflicting priorities between maximizing the profitability of the firm and making sure that the investment returns are as high as possible, because those can come into conflict. Secondly, does the manager have skin in the game? This often gets asked, but I'm amazed at how many people say, yes, I put my annual ISA allowance into my fund every year. That's not a big deal. I would expect fund managers to have at least 50% of their net worth in the funds that they manage. And you should ask yourself, if they're not willing to do that, why should you put your money in there? And then finally, what is their fee structure? And this topic could be a whole nother presentation. But just perhaps the highlight is really that I think people are waking up or realizing the fact that the existing fee structure, which is just to charge some percentage of assets under management, does introduce a conflict, because it incentivizes fund management groups to get as big as possible, which isn't necessarily aligned with maximizing the performance of their funds. And this debate is changing. A lot of funds are introducing, as we have done, fees that try and make sure that fund managers offer value for money by linking their fees to the performance that they deliver. And if you don't believe me, just 2 days ago, the largest pension fund in the world, Japan's GPIF, announced really radical sweeping reforms to how they are going to be paying their active managers. And they are quite something. Just to wrap up, thank you very much for your attention. At Orbis, we try and keep things simple for people. We only offer 2 strategies, both of which are available on the AJ Bell platform. On the left is a global equity fund, which we've offered in the UK for 4 years, but which has been in operation for 28 years. On the right is a multi-asset fund. It's a more stable fund, but it uses the same investment philosophy, investment approach, but it invests in a mixture of equities and bonds. With that, I think I'll wrap up. Thank you very much for your attention. Good luck on your investing journeys. And remember, we're not bridge builders. You have to be willing to go into, be different to the crowd and go into and not follow the crowd. Thank you very much.